Okay, so Monster Beverage just dropped some huge Q3 numbers. But honestly, the really interesting stuff happened after the prepared remarks, when Wall Street analysts got to ask their questions. So what are they worried about? What are they excited about? We're going to dive right into the investor Q&A and break down what it all means for the company.
Look, we listened to the entire call and basically boiled it all down to the 5 biggest themes that kept popping up over and over again. We're talking Europe's insane growth, what the future holds for the whole category, a totally new way of thinking about pricing, the push and pull on profits, and what's going on with their affordable brands around the world. By the end of this, you'll know exactly what's on investors' minds.
All right, first up, Europe. The numbers here were just wild. A 30% sales increase. And right away, analysts were jumping in asking, whoa, what on earth is happening over there? This was way more than just a good quarter. It was a total breakout.
So the big question really had 2 parts. First, why is the whole energy drink market in Europe suddenly on fire, even in places where you'd think it was already mature? And second, what is Monster doing to not just ride that wave, but to actually steal market share and grow even faster?
And get this. The answer from CEO Hilton Schlossberg was pretty eye-opening. He said that a full quarter, 1 out of every 4 consumers in Western Europe, is brand new to energy drinks. They just started in the last year. They're coming from water, juice, and, yeah, especially from those expensive coffee shop habits. This isn't just about the die-hard fans drinking more. It's a huge wave of new people flooding in.
So how's Monster grabbing them? Well, management talked about a powerful formula they're using. It's about having those reliable favorites like Ultra White that just keep growing, and then pairing them with massive blockbuster launches like the Lando Norris Zero Sugar drink. They made a point to say that this is what sets them apart. Some competitors, they argue, are just chasing newness, while Monster is firing on all cylinders. Okay, so whenever you see growth like that, the very next question from Wall Street is always the same. Is this sustainable? Can this possibly continue? Analysts really wanted to know if this incredible momentum could carry over into next year. So yeah, what's the game plan for 2026? Everyone knows the comparisons are going to be tougher, the economy's a little shaky, so what gives management the confidence that this isn't just a one-time thing? What are the actual drivers that are going to keep this train rolling?
Well, management laid out 5 key pillars. They're convinced there's still a ton of room to get their drinks into more households. And that value gap between an energy drink and a $5 latte, that's a huge advantage. Plus, energy drinks are just becoming more normal, more socially acceptable. And at the end of the day, people always need energy. You add a packed innovation pipeline on top of all that, and they see a pretty clear road ahead.
Okay, let's switch gears and talk about money. Our third big theme is pricing. Monster just rolled out some new pricing in the US, but analysts were sharp. They noticed this wasn't just your standard across-the-board price hike. It was something a lot more complex. So analysts wanted to get under the hood of this new strategy. What exactly is changing? What do they mean by cutting promotional allowances, which is basically the money they give retailers for sales? And what does that all mean for the bottom line? How much of this new price is actually going to turn into profit?
The company's chief growth officer, Rob Geer, used this great phrase to describe it. He called it RGM, or Revenue Growth Management, and said it's a mix of art and science. Okay, so what the heck is RGM?
In plain English, RGM just means being way smarter and more strategic about how you price things. And honestly, this is a really big deal. For a company that, in the past, has mostly just announced simple price increases, this is a major evolution. It's about finding all the little ways you can increase revenue without just slapping a new sticker on the can.
And here are the 4 big levers they're pulling now. Rate is the one we all know, just raising the price. But they're also getting smarter with trade spend, maybe doing fewer buy one, get one free deals. They're pushing the package mix, trying to sell more of those profitable multi-packs. And they're focused on channel mix, selling more in places where they make a higher margin. It's a surgical approach, not a sledgehammer.
So all of this stuff, the incredible growth, the smarter pricing, it all eventually funnels down to one of the most important numbers for the business, gross margin. Basically, how much profit they make on every single can they sell. And for Q3, that number hit 55.7%. Now that is a very, very healthy margin, and it was better than a lot of people were expecting. So naturally, analysts wanted to peel back the onion and figure out what was pushing that number up and what was trying to pull it back down. And this slide lays it out perfectly. On the one hand, you had tailwinds helping out. Those pricing actions, lower supply chain costs, and selling more of the high-margin zero-sugar drinks. But
Pulling in the opposite direction, you had headwinds, more money spent on promotions, higher aluminum costs, and a sales mix that tilted more international. And as we're about to see, international sales have lower margins, so that actually dragged the average down. It's a constant tug-of-war.
Speaking of international, that brings us to our final big theme from the call. Monster has been pushing these affordable energy brands like Predator in places like Africa and Asia. And analysts wanted to know, how does that fit into the global profit strategy?
Here's the core issue. Historically, Monster's international business has never been as profitable as its U.S. business. So the billion-dollar question is, can these new, cheaper brands actually help fix that long-standing problem and close the margin gap?
First, let's be super clear about the problem. When Monster goes overseas, they run into tough local competitors, which forces them to keep prices down. And on top of that, they just don't have the massive scale they have in America, so their costs are higher. Lower prices plus higher costs, well, that's a recipe for squeezed profits.
And this is where the affordable brands are a really clever solution. See, instead of shipping heavy finished cans of drinks all over the world, Monster just sells a high-margin concentrate to its local partners. Now, the CEO is very clear, this isn't going to magically close the profit gap overnight. But because it's a concentrate model, every single sale is profitable and makes a positive contribution. It helps.
So when you put it all together, it really comes down to this. Monster is heading into 2026 with a brand new, much smarter pricing strategy and a ton of innovation in the pipeline. The big question is whether the sheer power of their brand and their proven ability to pull new people into the category will be enough to keep this growth story going strong, even if the global economy gets a little rocky. That's the tension Wall Street will be watching all year.